Hi, I am Anna. I come from www.ntvforex.com. Markets Outlook: a week for trading by numbers rather than headlines. Analysis. http ntvforex.com News ID 6E835A 8/3/2023 12:40 AM. Weekly Wrap. There were some signs that U.S. hotspots saw coronavirus infection rates start to slow, while in other parts of the country and various pockets outside the U.S., investors were forced to stare down resurgent COVID-19 numbers. Interest rates continued to move lower, triggered by benign inflation readings in Europe and uncertainty about the trajectory of the U.S. economy in Q4. But with the market leadership U.S. tech firms reporting staggeringly good quarterly numbers and the FOMC reaffirming their enduring commitment to keeping interest rates low as far as one could see, stock market bulls are hoping they can confound most of Wall Street analysts' expectations and pull out another monthly advance in August. The hope is that the market will continue to do what it's done all year. Technology will continue to be the leader as the market pattern continues to hold, with index investors seemingly confident that positive vaccine results or a fall in the CV19 case count curve will allow weaker sectors to climb the ladder gradually. Megacap techs carry the U.S. equity market again. Factor, sector, single stock dispersion, and volatility underneath the surface are similar to last week. But mobility data could provide the best looking glass as we shift into August. Most global mobility restrictions trackers are no longer improving and consumer spending is plateauing. Watch out for the summer swoon. For currency markets, it was all about month-end flows. The British pound predictably bounced higher into month-end due to rebalancing, even though GBP was up 11 straight days, a new personal best for cable, according to Reuters data back to 1998. However, with the SPX up approximately 5% in July and the FTSE down 3%, the textbook signal showed two standard deviations of bust buying into Friday's London fix. If you expressed the view in early Asia through JPY long GBP JPY 137.20, you could have netted a tidy 200 pips 139.20. At the same time, and on the flip side of the curve, the fix also provided an excellent entry point to fade the GBP streak, which saw cable closing around 90 pips lower from the London fix high watermark. The much-studied and well-publicized month-end effect still works on average, not every month of course, even though it worked as far back as 2005 when I first started running and modeling EFX risk, after moving off the voice-only desk. But, overall, the US dollar strengthened into week's end, perhaps on month-end position squaring. Despite Friday's stabilization, the USD continues to face several challenges. Thursday's unbridled USD weakness was prompted by a record drop in US GDP, albeit less than expected, so data rather than policy transmission could be critical to the view. All the while, President Trump's suggestion that the election might need to be delayed provoked additional USD discord. The latter is fleeting angst as Congress holds the cards on the election call. With the continued environment of USD weakness, the ADXY keeps grinding higher. The Asia FX market is much more at ease after the Fed kept both USD liquidity swap lines and FIMA repo facility through March 31, 2021, previously September 30, 2020. The assurance of USD availability crossing both the September quarter end and year end will lessen funding concerns at the turns, and with the FOMC holding the door wide open to dollar weakness, I'm sure local traders will walk through that entrance with oodles of dollar to sell, even more so if the Eurist hightails to 1.20, which could happen into September when the Fed makes clear their intention to shift from stabilization to accommodation. Gold markets. The yield on the US 10-year eased to near 0.5%, putting the real yields with inflation striped below 1%. That's the lowest ever. In 2012, the convergence of the global financial crisis and the euro crisis reals dropped to 92 BP. Hence the reason gold is holding up despite US stocks ripping higher and a stronger US dollar heading into the weekend. Indeed, little makes sense to a market-trained eye these days. Gold prices remained buoyant, although the USD made a comeback that may have helped cap the gold rally. Investors retained a positive view of gold partly on ongoing CV19 concerns. Globally, cases keep posting record rises, while new lockdowns in Australia, parts of the UK and signs of a new upswing in European infection rates make for an unsettling picture. But when US real yields are lower, or negative, investors have no opportunity cost in owning bullion. There are a lot of moving parts when one looks at reals. Fed policy current and expected is only part of it. A weak economic outlook is another part, which is undoubtedly bullish for gold. If you think that the gold market's holy trinity, the Fed policy geared towards depressing real 10-year yields, the US dollar status as a reserve currency in question, and a continually spinning CV19 headline reel will remain in play, you need to own gold as key portfolio diversification. Week ahead. This week's economic calendar will provide the latest information on recovery progress for manufacturing and employment, both critical considerations for Congress as they continue to debate the next fiscal stimulus package. Friday's July employment report should steal the spotlight, even amid a strained political backdrop. Both parties appear to be far from reaching an agreement on the lineation of the next phase of fiscal support. Still, given the uncertainty and wide-based expectations that don't appear to be distilled into a consensus as yet, beats and misses should be met with more than a touch of skepticism because there is no consensus. For me, this week's game plan should revolve around the ongoing debate in Congress, which should loom large. Trades for the week ahead: stocks revert to the mean. I think it will be another week to trade by number rather than headlines. It's pretty easy to pick a narrative to fit one view at the moment. Equity bulls can lean on the impressive results from the tech firms and argue recent softness in the broader market is month-end related. Fixed income bears will also tell you the same thing as they try to explain away the latest drop in yields. On the other side of the argument, the fixed income bulls and equity bears will argue that the decline in yields in fixed income means markets are increasingly concerned about what lies ahead. At the same time, an uptick in virus cases adds to that concern. The truth likely sits somewhere in the middle of those extremes, suggesting markets will continue to revert to the mean as policy support provides a large downside insurance pillow. In contrast, the negative economic effect for COVID will continue to weigh on topside ambitions until a vaccine is found. Finally, despite Chair Powell's dour economic outlook, there were few signs of panic in U.S. stocks, suggesting the Fed's zero forever view is supporting the wall of money argument. The euro held hostage to month-end proclivities on the euro. Due to month-end proclivities, the smart money is overhedged on the downside into month-end, so it will be a waiting game to see how quickly that plays out and reverses, as month-end flows can drag on 24-48 hours. But with FX traders shifting from policy transmission to growth differentials influencing most trading decisions this week, economic data divergence could be critical next week. But I still think the market will be looking to optimize US dollar shorts beyond the euro, as real rates compression could accelerate the USD dollar sell-off next week. Oil caught between short-term negative and long-term positives in oil. There's little going on other than the fact Brent is now shifted to the October contract. But it was a strange week at times, as Brent fell well below $42 before rebounding again. The $43.50 BBL mark seems to be the center of mass for the new October contract. Last week prices were seemingly getting driven by fear of COVID outbreaks, political uncertainty in Washington, and a gnarly US GDP figure, which provided the poor eye candy and reminds us that oil markets, unlike forward-looking assets, are not immune to bad data. The same themes continue to be recycled, but the balance between positive longer-term sentiment and near-term negatives, increasing coronavirus infections, rising OPEC, and U.S. onshore production has kept oil in a relatively tight range in recent weeks and on an upward trend for 3 consecutive months. On the demand side, if the market continues to trade on fear of the virus, things could point lower. Still, I think where the trouble lies is that positive sentiment could be tested in August as near-term pressure building on the supply side becomes harder to ignore. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.